if you search the Fed's balance sheet and you create a year-over-year stacked, rate of change chart with, broken down by maturity, you'll see basically
Yep.
like the blowout in each maturity as the Fed does QE. And when the Fed switched to QT, you can see that, the 1-year bills, the 2-year notes, the 5-year and 7-year notes all went negative, meaning like year over year, they were getting rid of them, right? They were laying them off. They were allowing them to fall off their balance sheet, and they were deleting bank reserves as compensation for getting rid of these assets. The one line item that didn't decrease year over year was the bonds over 10 years. And
Yep.
so that tells me two things, right? That means that the Fed was able to taper in the sense that they can lay off the short-term debt. They can get rid of the bills and the notes. They can't get rid of the bonds, which are everything past 10 years. So that means that the market demand, the structural market demand for long-term bonds is very weak. And if the Fed allowed those bonds to be laid off, meaning like, get rid of them, enter the market, like either sell them or just let them, mature and expire, then that means that the yield would have blown out to a very significant level. And the Fed did not want to allow that to happen. And so their monetary mechanic was, let's reduce the bills on the short end or on the front
Yep.
end. Let's increase or keep steady the long end. And since our overall balance sheet is falling just because of the amount of decrease in the bills, no one will notice, right? No one will catch us doing this kind of monetary experiment. And,
Yep.
it worked. Most people did miss it.